Did the Fed make the right move this week by hiking rates again?
If inflation's sticky and stubborn, there could be more hikes down the road.
April's unemployment report shows a robust job market and continued wage growth, which may not be good news for people who are looking for the Fed to cut rates. What this jobs data means for the Fed's path ahead.
They've got the job side of the equation and they've got the inflation side.
In its latest policy on Wednesday, the US Federal Reserve raised the key interest rates by a modest 0.25 percentage points, continuing its fight against sticky high inflation. In this video, we're going to explore Cathie Wood's viewpoint on the recent rate hike by the Fed. She shared her views on recent job reports and inflation and what it means for the economy and the market. So stay tuned until the end of this video to know more. But of course, be sure to subscribe to my channel for more of the latest updates on the economy, crypto, and the market. Also, don't forget to hit that bell icon to never miss any video. Let's get into it.
Well, this week, the Fed did increase the Fed funds rate again, 25 basis points. We're now at 5.25, 21 times where we were a little more than a year ago. So a 21-fold increase in interest rates from 25 basis points to 5.25. Now, never has the Fed raised rates in the middle of a crisis. And they do seem still to be separating or compartmentalizing what's going on. We have the tools to deal with a crisis, and we're doing that. And we need to fight inflation as right now a primary goal of monetary policy.
Just a few days back, the Fed again hiked the Fed funds rate by another 25 basis points. The Fed claims that fighting inflation is its main priority right now. This marks the 10th rate hike in just over a year and is the 21st consecutive increase since March of 2020. But what's even more surprising is that they're doing this in the middle of a crisis. We all know that the economy is struggling with high unemployment, low growth, and rising inflation. The Fed's decision reflects its concern about inflation, which is its primary goal of monetary policy. However, the Fed also faces a challenging economic situation amid the ongoing bank crisis. The Fed says that fighting inflation is their primary goal right now. The Fed's policy stance seems to separate or compartmentalize the two issues rather than addressing them jointly. They're risking a double-dip recession or even a depression by tightening monetary policy too much and too fast. Leave a comment below and let me know what you think of the Fed's actions. Let's get into the next clip to hear more from Cathie Wood.
We saw the unemployment rate drop to 3.4%. That ties recent history for a low. You have to go back to the 60s, 70s to see lower. And, you know, that's why a lot of people, and I think Powell and many on the Fed included, think we risk a 70s style inflation. We don't agree with that at all. I've said many times the 70s inflation started in 1964, so it built over 15 years before Volcker tackled it. This inflation, we think, is supply shock driven from COVID and the Russia invasion of Ukraine. So we take issue with that. So the employment itself, non-farm employment, came out higher than expected, 253,000. Expectation was 185,000. But we're learning something very important from these reports. Downward revisions to previous months, which always happens at turning points. So last month, when I was giving this presentation, we thought that employment had increased in March by 236,000. It turns out, after this first revision, that the actual increase was only 165. Now think about how differently the markets would have responded if we got that number. And it may be revised down again. We get a lot of downward revisions at turning points. And in fact, we've gotten 149,000 jobs revised down just from this one report. So employment's a lagging indicator on top of all of this. So I don't know why we spend so much time on it, except that the Fed's spending time on it. And that's unfortunate.
The employment report for April was better than expected, with 253,000 new jobs added compared to the 185,000 that was forecasted. But we should be more careful not to overreact to this number because there were downward revisions to previous months. The Fed said the country's economic activity expanded at a modest pace in the first quarter, and job gains had been robust in recent months, and the unemployment rate had remained low while inflation remained elevated. The unemployment rate in the US has fallen to 3.4%, a level not seen since the 1960s and 1970s. Some people, including Powell and some Fed members, are worried that this could lead to high inflation like in the 1970s. However, Cathie Wood disagrees with this view. She thinks that the inflation we're seeing is caused by supply shocks. But the central bank said it seeks to achieve maximum employment and inflation at the rate of 2% over the long run. The Fed, in the last meeting on March 22nd, hiked interest rates by 25 basis points. The move was aimed at curbing inflation, which has been stubbornly high for months. The Fed also dropped a hint that it may pause its rate increases as it removed a phrase that suggested more policy tightening was needed. But before going ahead, don't forget to give a big thumbs up to this video.
Now, the Fed is also focused on another lagging indicator, average hourly earnings. That was another positive or upward surprise. It's negative for the Fed. They don't want that. So 0.5 versus 0.3 expected. So on a year-over-year basis, average hourly earnings are up 4.4%, not 4.2%. Here is where we come into another concept that is going to throw off statistics, and it is, are we measuring the economy correctly? We do not believe we are. And we believe that productivity is mismeasured. And we're going to be putting out a convergence report and getting into that later this year. So if productivity is up 2 to 4%, which we think it easily could be, just think about what ChatGPT is doing. Just use your imagination. And then 4.2% average hourly earnings is not inflationary. So, and it gets us within our 2%, the Fed's 2% desired range. So how that works is wages up 4.4%. And if productivity is up, let's just say 3%, then you subtract productivity from that 4.4%, and you've got roughly 1.5% underlying inflation.
What do you think of Cathie Wood's viewpoints on Fed's rate hike? Will the Fed pause after this rate hike? Let me know your thoughts in the comment section below. And of course, don't forget to subscribe to my channel for more updates on crypto and the economy. Also, be sure to hit that bell icon to never miss any video. Thanks for watching, and we'll see you next time. Adios.